Now, joining us for more on the debt deal in Washington is former Deputy Treasury Secretary under President Clinton, Stuart Eizenstat, currently a partner at Covington and Burling. So, Stu, our Bloomberg View editors say that basically what we've inherited or what we've developed is a mess here on the budget. Would you agree?
I would. I mean, the only good thing about the agreement is that it avoids a default. It's a down payment on some of the deficit reduction that needs to be done, and it exempts from automatic cuts some low-income programs. But overall, Betty, it's really the wrong prescription because it has too little deficit reduction in the long term. We need $4 trillion, not a maximum of $2.5 trillion, which this provides, and it's too much reduction in the short term. Now, the actual amounts aren't that much. It's a cut of $25 billion in 2012, 47 in 2013, but that doesn't take into account the fact that this agreement allows the 2% payroll tax to expire. It's very important that that actually continue. It also doesn't include extended unemployment insurance. So when you add all of that together, you have a destimulative impact on an economy that's already reeling. It's sort of like a boxer who's been punched, goes back to the ring. Instead of getting the smelling salts, he's pushed back on to fight another round.
Right. So you see this, perhaps even more so than our prior guest, John Riding, as a much more negative for the economy then.
I think that it is a potential negative, and it puts more pressure on the Fed to act. And the reason is, again, if you look at the actual budget cut numbers, the administration did a very good job of pushing as many of those off to 2012 and 2013 as they could, when hopefully the economy is stronger. But they did not get an extension of the payroll tax cut. They were actually hoping to expand it so that it covered both employers and employees. They didn't get an extended unemployment insurance, so that takes more money out. And Betty, I think the other thing that has to be taken into account is one of the reasons the economy is so weak is state and local governments are hurting so much. They're the ones that are cutting back more on hiring than the private sector. This agreement is going to assure that the federal government transfers even less to hard-hit states.
Right, and forget about, we're talking job losses for states and municipalities, not job hiring. Then, Stu, you said something interesting a few moments ago about putting more pressure on the Fed. What do you think the Fed has to do then?
Well, the Fed is meeting August 9th. My guess is that they won't take any precipitous action, and they may wait for one more quarter's figures. But when you consider, Betty, that in the first half of this year, we have growth that's less than 1%. When you get the manufacturing data that comes out yesterday, which is barely positive, they really have three choices. One I think they won't take, which is another quantitative easing. They've got so much already on their portfolio in terms of mortgages and treasuries, $2 trillion, they're not going to add. But there are two things they could do. One is to make a specific commitment to keep short-term rates low for, say, 12 months. And second, they may want to adjust the mix in their portfolio to include more long-term treasuries, so it helps drive down long-term rates. But other than that, there's not a lot they can do.
No, but I mean, that doesn't sound like it's going to make a significant mark on the economy.
Well, it will make some mark. You know, we should remember that Ben Bernanke, and thank goodness he's where he is now, he got his PhD in the Great Depression. He remembers the lessons of 1937 when FDR prematurely cut back on government spending, tried to balance the budget, and aggravated the Great Depression. He doesn't want to do that, and neither should we do the same on fiscal policy.
Then, Stu, if you were still at the Treasury right now, what would you want to do? What would be your next steps?
My next step would be to go to the Congress and say, look, what we need to do is we need to increase the payroll tax and extend that payroll tax to both employers and employees so that we don't take more job-creating stimulus out of the economy. I would go to the Fed and I would say to the Fed, we want some easing on monetary policy so we get some mild stimulation there. Now, I think in the bigger picture, Betty, there's one other factor to look at, and it goes beyond economics. We're entering into a period of austerity where the whole footprint of the United States globally, militarily, politically, and economically, is really at risk. The kind of military cuts, for example, that would be triggered by the automatic cuts if this new commission or the new congressional committee can't agree on another $1.2 trillion in cuts would be draconian. You're looking at the potential of $1 trillion in cuts over 10 years in the military. That's going to mean less procurement and less jobs, but it also is going to mean less of a military footprint in East Asia, less of a capacity to fight counterterrorism. So this is a really big deal, and it ought to be put in that broader context.
Okay, Stu, judging from what you're saying, you've thought a lot about this, of course, and have a lot of prescriptions for what to do about the debt situation in the economy. I always appreciate you joining us, Stuart. Stuart Eizenstat, the former Deputy Treasury Secretary under Clinton.